What is up, dudes and dudettes? This is Due Diligence here, and today we're gonna talk about ticker symbol Adobe. Okay, a couple of hours ago, Adobe's during market open, Adobe's share fall about 12%, and it automatically recovered by 2%. And a lot of people are like, "Man, should we buy the dip?" I heard like Jim Cramer put out a tweet and saying that it's a good time to buy the dip. I actually, surprisingly, I actually kind of agree with him in a sense. If you go look at Adobe's top stories and you search Adobe's forecast full year earning, so basically before I tell you about why it is actually a good idea to buy in right now, we have to really discuss how Wall Street is structured in terms of big name sounds like Adobe, Tesla, Apple, blah 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 blah. All these stocks that are expensive for regular people to buy or for regular peasants like us to buy, they have like a very intrinsic, not really as sophisticated than we thought, but they have a little capital structure, or what we call Wall Street expectation structure, that basically piling up on their expectation of the value of the stock. So if we slow down a little bit and sort of unwrap these structures, so you have two layers in the structure. You have the actual fundamental value of this company, right? So let's write it down. So first of all, there's one structure. This entire Wall Street thing has two layers of structure. So first layer is the fundamental value, right? Fundamental value. So how we're gonna get the fundamental value? You go look at their 10K, their 10Qs, and occasionally you go look at their 8Ks. Well, those are, current disclosures and stuff. And then what you do is, the simplest way of doing this is you look at their revenue growth. In this case, we don't really care about the revenue growth because it doesn't really becomes useful in the construction of this argument, because I'm not even gonna use revenue as a part of the equation. If you guys want to use revenue as part of the equation, and if you want me to post a more detailed video on analyzing their financial statement, using their revenue and all of the information I'm gonna give it out today to analyze where this company's price value is gonna lie, or you want my algorithm to run this company and sort of forecast and run like 10,000 simulations and figure out where this company is gonna be sitting at after 365 days, comment down below. We might make that kind of video. Okay, but in here we don't really want to talk about the fundamental value, because in order to explain how we're gonna derive fundamental value, it's gonna take at least 10 videos, because it's a little bit more complicated than you think. In here, we're going to talk about the estimated value, which is determined by Wall Street. And since we're semi-big data analyst, stock trader, whatever you call us, we collect data on Wall Street's estimate, basically. And then it turned out that 90% of the time, the estimations are wrong. Right? And then usually most of the time people beat estimations. Company beat estimations most of the time, right? Let's use this. Most of the time. And you have occasionally, well, actually what I mean by occasionally means like all these big companies. Bigger companies rarely miss estimations. And I'm going to tell you why. Like, a lot of you are going to be like, life is just like a, wheel of fortune. And sometimes if you go up to a really hot chick, there's a 50% chance that she's going to go out with you. And there's 50% chance that she's not going to go out with you, right? Or you're a humble guy like me who doesn't really have very appealing physical attributes, who probably just have a bigger brain than 99% of the people. And consider hot chicks are usually very shallow when you go up to them, and they're probably going to reject you, right? For normal guys like you guys, probably have a 50-50 chance. For me, probably like a 20-80. So, because all these companies, they have very smart people that sort of like manipulate these estimates. Therefore, they figured a way to beat the 50-50 game. How? What they do is before, so what they usually do is during Q4, which is we are right now, right? This is exactly why this is related to Adobe, because this is exactly what Adobe is doing right now. So during Q4, what they're gonna do is they're gonna put out an earning call, like all sunshines, all sunshines and good earnings for right, the year end 2021 in this case. But what they're gonna do is they're gonna throw a sort of like a rotten cherry on top. So at the end of the call, they're gonna lower earning forecast for next year. Okay, so what are some examples? And previously when they did it, they previously did it during 2020. By the end of 2020, they're saying 2021 forecast is not going to be that great because COVID, blah, 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 right? During 2019, they talk about supply chain shocks, blah, 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 blah. And what happens there is you will see a unanimous result of all these companies' stock fall. And usually, it falls somewhere around 7% to about, I think the biggest fall we see is actually 15%. And then all the data are driven from companies that we think that are big names, or a lot of people like buy them, or do you have a lot of liquidity in there, and blah 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 blah, right? What is interesting about those falls is you have at least 65% chance to about 75% chance that you will have a sharp recovery. So this is the general stuff going on, right? The background stuff going on. But why Adobe, right? The question is why Adobe? So there's some simple math you can do to figure out why Adobe. So first of all, right, today Adobe's so this is the news, right? Expected revenue is 17.9 billion, and I'll just say the Wall Street projected 18.2 billion. But for the simplicity of the math and everything, let's just say Adobe is gonna miss Adobe missed the estimate by, let's just say 1 billion, okay? So we take out our precious calculator here, and let's just say 1 billion out of 18.2 billion is about 5.4%. And because you have like an implied lever, which means whenever you're trading on a blue chip stock, technically speaking, most people trade them not really holding them. They just hold a portion of it and they trade options. Therefore, their actions are levered. What does it mean your actions is levered? That means essentially before it was levered, when it goes up by 1 point, you only get 1 point in return, right? But when everything is levered, you have a magnifying effect of how much return you're going to have. But the same thing is when the stock drop, you're going to have 2 times the effect. And here, the leverage here is 2x. Therefore, when earning estimate, or what they call the earning expectation estimate, was missing by the estimate of this estimate by the Wall Street, you see here, I'm trying to make it funny here. Like you have so many estimates here, and then like the estimate of the estimate of the estimate is 5% off. Therefore, the market is probably going to drop around 9.8% to about 10.8%, which let's see if it's true or not. It is true, it dropped by 10.5%. Okay, so that's normal, right? So then you guys are like, so what are we gonna do with that information? So first of all, you have to figure out what's the basic value that, or what's the basic growth without accounting their revenue growth of their stocks is gonna be next year, right? So here's a very easy way to do it. All of you know that how do you really price a stock? So textbook cases of pricing a stock. So what you do is their market share, their how many shares outstanding, right? Market share outstanding times the price of the stock, equals to market cap, right? And when you have a market cap, which in here the market cap doesn't really change. Why? Because they only shifted their estimate, and then from the statement of the estimate, we know that they're still going to retain their growth, just not growing as much, right? So then the market cap of this company, if we fast forward the timeline, or we're just staying the timeline right now, it doesn't change. But what changes is you have price of the stock drop by 10%. So then that means in order for this equation to stay the same, that means your market shares either have to go up by 10% or the price will recover. So let's look at the movement of market shares. So what is interesting about Adobe is Adobe keep buying back their stocks. So they around 2017 to 2018, they bought back about 3 million of their stocks, and then their buyback actually accelerated. They bought back 6 million, and they bought back almost 10 million shares of their stock. And then what is interesting is during 2021, they bought back about 10 million, because if you see the current market share outstanding is 475, and then if this trend sustain itself, that means Adobe is probably gonna either buy back another 10% of their shares, or somewhere around they're gonna probably maneuver the market a little bit and sort of recapture 5% of their stock. Which means if you are a long-term investor, when a stock like this drop by 10%, and you know their annual deduction of outstanding shares is about 5 to 10%, then you know that at least your value recapture will be 5% of that loss. Well, to be exact, it will be 5% of tomorrow's opening price. Okay, so this is why it's such a good buying point. But also another thing you have to understand is, okay, so it have a yearly outstanding share deduction of 5%. So let's figure out what is it at, around December 2020. So around December 2020 is about 508 or whatever. Let's just say 508. It's $508. So if you have 508, sorry, it's the wrong thing. 508, and you know that the natural just outstanding share dilution, right? It's not dilution, it's de-dilution is about 5%. So you just add that up, right? Times that, then I give you 533. So you have 533 as an anchoring point. So let's just put 533. Where's 533? Oh wait, it's here, right? If you look at this, it's right here, 533. Oh my God, there's a support line right here. Just because there's a little dump, right? For those of you who are a little hump, for those of you who believe in technical analysis, you're like, oh my God, it's just very consistent with our technical analysis, right? Okay, I mean, I can get it all by just pure math. I don't really care about technical analysis really anymore, because technical analysis, actually my algorithm can prove to you that technical analysis is let's just say it's not as accurate as quant analysis. So then you basically figure out your maximum loss here. So your maximum loss here is, sorry, wrong thing again, 566 in here minus 533 equals to $30 divided by 566. So your maximum loss is another 5%. But what is the probability of stock like Tesla, Adobe, Apple drop by 5% per day every single day? Well, disregarding this part, because you have drop, recovery, gap, recovery, gap, drop, recovery. This is 2.5%, this is 2.5%. Gap down, recovery, gap down, recovery. You see this pattern here? So therefore, tomorrow, if the market opening price is somewhere around like 550, then if you are a day trader, it's heaven, because it's going to recover, and because it extends to the Christmas rally week, therefore the Christmas rally trajectory actually is already laid out on Adobe. So if we actually use G Ink and then map out the trajectory, the Christmas rally trajectory is actually from here to all the way here. Which means if you're an option trader, then you can actually aim for the 590 call option, or if you want to maximize your profit. But the probability of you hitting there, depending on the option flow, is really depending on what the Monday option flow is. But what will be a really good strike price to really buy right now is until tomorrow, whatever opening price tomorrow, you buy it at the money call at the same time when the market open, you're basically guaranteed a return of at least 2.5% levered, depending on what the leverage of your option is. Okay. So without further ado, let's just do the definitive price range of Adobe right now in terms of like the next week or a month or whatever, right? So hypothetically speaking, so tomorrow we said we're going to open up in here. So let's just say tomorrow we open up at 550. Okay, let's just say it's 550. So the definitive range here is tomorrow the opening price is 550, and then your lower bound range, let's use another pen, is 533. And then your upper bound rally is 592. So what's your expected return around this? Your expected payoff ratio is exactly this. So you have 50, so it's 42 on the upside, and then you have, this is 17 on the downside. So your expected return is this. This is just a very simple weighted expected return, 25. So 25 over 550 is 4%. So your expected return is 4%. But if you are hasty and just buy it back by today, then we basically are increasing, basically we're decreasing our odds of upside and then sort of increase our downside thing. But you know, if you're lazy, you just capture a lesser return than this. So you have 565, right? You do the same exact math and then do 92 minus 65. I can probably do it in my head, but hey, you know, I'm lazy. And then it's 27, and then what you do is minus 533, it just happens to 32. So your expected return by just buying in today, during right now, is about -5. So -5 divided by 565, you have a 0.8% expected return of a -5. Now you have a 0.8% negative return on if, you know, your maximum downside is weighted the same as maximum upside. But in reality, the weighted average of this, you actually should put more than 50% on here and then less than 50% on here. But also, we don't want to max out our potential, so you probably want to lower your target estimate. So where your target estimate, so 570 will be a really, really good target estimate. And then in terms of like an option flow, $5 of an option change will probably yield you at least about 120% return if you're doing it at market. Okay. But anyways, these are for the option analysis. But for you, if you were just a regular stock buyer, then here's the appeal here. Okay, this gap down is too big. There has to be a recovery the next day, or if you see another drop down, then you probably just wait. Let's just say you can allocate this much of money. Then what the optimal strategy is, today you will probably buy about 20% of your total whatever money bag you have, a dry powder, and then wait until tomorrow. If tomorrow it happens just as I told you, or just as I predicted, then what you can do is, well, market open, you always buy like around 5% because you can trade like volatility or whatever. If you see a consistent trend there, then you can add a lot of 10% and then just wait. You know, and if Christmas rally happens, you can slowly add up, or you just stay that 30% exposure rate, right? Because, you know, after Christmas, there might be some hard weeks there. But if you're just a long-term holding investor with our 5% annual deduction of outstanding share and whatever growth rate they have, that means by the end of, let's just say, not really end, by the mid of 2022, the stock price should probably be higher than wherever this is. Well, technically, it should be higher than whatever our January ending price is. So right now, we cannot really forecast into January because there's a probability that January, the interest rate is going to hike, and it's going to hike about 0.25%. But, you know, disregard that comment. So right now, what you really need to think about is if you want to enter, you enter a small position. If you just enter 13% to about 25% of that, you can just wait, because this amount in about 252 trading days, this will be at least at 570. So you will have $5 worth of profit in a year. But yeah, I know this stock is really expensive. So in terms of like you know, a growth plan is not that great. What you're really aiming for is basically you just buy like a small amount in here to mark the ticker, because the general growth of Adobe's products actually will increase next year. And if you guys want to know about that information, I can post a video on that one. But right now, what you have to know is it's a really good buying point, especially for next week. All right, this is it for this video. Hopefully you guys love it. See you guys on the upside.